Welcome back to Market on Close. Just a few minutes left in the trading day, so it's time for the big picture. Let's welcome in our team from Charles Schwab. Joe Mazzola is joining us now, the head trading and derivatives strategist, of course, at Charles Schwab. Joe, thanks for being with us as always.
Thanks for having me. How you doing?
Now, what are your thoughts on today's session? It started out pretty deep in the red. It looks like we might not be quite as bad now, but what are your thoughts?
Well, look, we tested lows 57.67 and held the 200-day moving average. And what it started off as a lot of questions and a lot of selling kind of at the open where people were kind of shocked. I mean, I remember this morning as about 4 a.m. my time, I look at the futures, we're down 15 points. I said, nothing big going on. Next thing I know, it's down 70 points. So, when you see those type of moves, and it just reminds you that there's a lot of volatility that's still in this market. It might kind of be buried under the surface, but once you get some type of a tweet or something that can move things, it can move very quickly. I'm really impressed with the way that the dip buyers kind of stepped in and pushed it back up. We're vacillating around down 30 points or something like that in the S&P, but could have been a heck of a lot worse.
It certainly could have. I mean, just in the opening minutes this morning, we did see that dip push the S&P down to its 200-day moving average. We've recovered some since then. But what are your takeaways from the headlines that we saw today? Because that's what all of this action was tied to.
Yeah, I would say one of the things that I've really been paying attention to was just the reaction from the bond market. I know you guys have been talking about that all day, but think about how bonds initially reacted in the beginning of April when the tariff announcements were laid out. So it wasn't only the equities that were selling off, bonds were selling off as well too. Inflation targets shot up, and people were just trying to kind of reorganize their thoughts and maybe start planning ahead as to what could this mean for the economy and in terms of what does that mean for price appreciation. But what we're looking at now, and I think there's been a shift. I think the shift is now tariffs aren't necessarily looked at as inflationary. I mean, of course they are, but they're actually more looked at as potential for slowing down the global economy. And I think that's why you saw bonds pull back a little bit, or bond yields, pull back a little bit today, and bonds rally. It wasn't a big move, but boy, we could have been set up for a pretty decent move in the yields this morning. And the bonds held up. So I took that as a sign that the market is now digesting that information, not necessarily as inflationary, but more in terms of what could that mean for slower economic global growth, and how do you kind of price that in? So I think we've seen that turn a little bit. I think that's an important thing to take away.
And as we talk about the yields, we saw U.S. Secretary of Treasury Scott Bessent step in earlier today trying to calm the market, saying we could see something on the supplementary leverage ratio for banks over the summer. What do you think that will do to yields?
Well, I mean, his hope, or at least what he predicted, is that it could be potential for 10 basis points, even more, right? I mean, and if that's the case, and markets can kind of grab onto that, I think that can steady some of the bond volatility. Remember, right now it seems like bond volatility is kind of leading the way. We've seen it slow down a little bit. But at the same time, equity markets are keying in on what the bond market is doing. And if you can see that the move index, or whatever you're looking at for the bond volatility, if you see that kind of steady, you can see the market catch a little footing like it did during the day today. You can basically tie the turnaround that we saw to those comments. Kind of was a steadying force, and it helped get the dip buyers back into the market to buy the equities.
Mm-hmm. Even with that turnaround, as I'm looking at the numbers, S&P is still on track for its worst week since early April right now. NASDAQ and Russell both down quite a bit as well, respectively. Do you think that this will calm once we get through the holiday weekend, or do you think that we'll continue to see more of this sell-off? Is there any conviction here?
You tell me what tweets come out over the weekend, and I'll tell you whether or not
fair enough. If we can get an advanced look.
I think that's fair. I mean, I think the way to look at it is if we don't hear much over the weekend, then yeah, sure, they can have a calming effect. But I think the way you have to look at the market right now, and one of the things that I've been really kind of paying attention to, is what's happening with institutional hedging. We saw a lot of put buying kind of in that beginning of April, and got to the point where the puts over calls, that skew was in the 90 and 95th percentile. A lot of that was taken off. I think a lot of that was responsible for the rally. I think institutions got caught off sides, maybe a little bit too short, maybe a little bit too hedged. And so when the market started to rally, they were buying because they wanted to catch up. I'm starting to see that those puts getting bought again, and they're the 30 days, the 60 days. What does that align with? That aligns with the expiration of our moratorium on tariffs. So it looks like institutions, at least at this point, are pricing in some volatility as we head into that July 1st expiration date, July 2nd expiration date. If that's the case, then I think we need to, as investors, be mindful of that as well too. That there's probably some volatility around the corner.
And one more question for you, Joe, as we move into our short trading week next week, what are you specifically looking out for?
Well, durable goods comes out first thing on Tuesday, so it'll be interesting to kind of see whether or not those are holding up. Right, those are the higher priced items. Those are the things that could be affected by a weakening wallet share for consumers. Consumer confidence, I think, is another big one we want to pay attention to. And then, of course, there's always claims, right? So jobless claims, for the short term, but then continuing claims. I know you asked your previous guest, what could move the Fed in order to cut rates. It's employment. Right now, employment's holding firm. But if you start to see that rollover, we start to see continuing claims start to push back up. We get maybe that unemployment number over 4.5%. Then you might start to see the probabilities of a Fed rate cut improve. That could kind of push it forward to maybe July.
Thank you so much, Joe, as always, and have a wonderful weekend. Again, Joe Mazzola of Charles Schwab.